Are good companies a good investment? At first glance, investing seems like it should be easy. Just buy shares in good companies, sit back and profit. That's not how investing works. A good company is a good investment. The fallacy is something every investor needs to understand. A good reputation, strong competitive advantage, and popular brands may be not only hallmarks of a healthy Wall Street company, but also a sign of a poor investment idea, researchers at CFA Institute and Morningstar found. Today in this video, we will discuss a fallacy quoted as good companies are a good investment. Studies have proved that this is not true. In fact, the less popular names are more trusted to deliver good returns on their investments, instead of known names and other renowned companies. This is said to be because of their higher prices, which lead to lower expected returns. Their share price is more likely to depreciate. Welcome back to Skillset, guys. This is the channel where we discuss finance, business, marketing, money, and of course all things crypto, NFT, metaverse and blockchain related. We are just another group crazy about keeping you updated and entertained. Don't forget to like and subscribe and hit that bell button. Moving on to our topic for the day, let's roll into the video. What do we mean by good company? Good companies can be said to be those which are known by almost every house next door. It's a brand with great dominance in the market and recognition among the public, trusted services, excellent services, and great profits. There are two most popular methods to calculate which companies can be seen as good by investors. This would include looking at the company's brand value or Nielsen-Harris Poll reputation quotient for seeing America's most admired firms. The investors also study higher past returns and price multiples. These good companies are not always also good for investments. For that, other messages are used, like sorting stock returns based on the brand value, measuring the company's popularity, network effects, intangible assets, cost advantage, switching costs, and efficient scale, along with Nielsen's Harris Poll reputation quotient. What affects company stock prices? A company's stock price doesn't take off just because it's a good company. It takes off mainly because it's drawing investor interest. Today's market is held with different types of options, and investment flows are largely driven from the top down. No matter how great a company is, its stock price growth could be limited if it doesn't draw the attention of the big funds and institutions. It could go for many years without being noticed, causing its stock price to decline. A study showed a negative relationship between the two, brand value and stock returns, in the data recorded for the periods between 2000 and 2017. The higher brand value lowered the returns, and the lower brand value appreciated the returns on the investments made due to their competitive advantage. And all of it with a jaw-dropping margin of over 5% per year. Similar results were found in data from older years. A company could be so popular with institutional investors that the stock price can rise to levels that may not be sustainable. It may be a great company, well managed and offering winning product lines, but its fundamentals don't justify its stock price. The very low P/E doesn't necessarily mean the company is a good investment, and it could still be in a winning position if it pays an above-average dividend and shows at least slow, steady stock price growth. How companies' reputation and stock prices affect investors. It has also been studied later that firms that associate themselves with prestigious brand names tend to have higher stock prices due to the higher investor sentiment involved. Thus, it isn't the retail ownership, but the company's institutional ownership that leads to the stock's depreciative effect. Higher prestige lowers the future returns on the investments made by the investors. Another paper suggests that the sentiment hypothesis states that sentiment misleads investors into believing that the stocks of companies with relatively positive sentiment will yield higher returns than stocks of companies with relatively negative sentiment, and that the sentiment is elicited by the names of companies rather than by their characteristics. That some brand names automatically invoke a very strong positive sentiment and approach, misleading the investor to think that buying their stocks is a good choice and will ensure great returns in the future with next to no risks. But this is unrealistic. The innocent investor tends to pay more money in stocks, getting next to no good returns. Such stocks are also known as glamour stocks, which performed well in the past and are expected to perform even better in the future. The expected underperformance of such stocks is also highlighted in another research paper published in 1994. And the reasons also include judgmental errors on the part of the investors who extrapolate past success for future success as well, overpaying to the company stocks. Value stocks, as well as glamour stocks, thus can be risky to invest in. The current situation of the investor and market. Recent times have shown the brand names like Netflix and even Google to be showcasing their growth potential, extrapolating even the best of the analysts to be thinking of profitable future returns, misleading them, mentioned in the paper from 2019. In such cases, the investors expect the company to create history by keeping their exceptional growth forever, which is not how the world works, even in the man-made cycles. This also gives rise to the definition of what might be seen as bad company by many. Like in the recent Netflix's case, when it fell in the market, its stocks fell as well, and the general public was triggered immediately to think of it as not such a great company anymore. The lottery stocks, like recent IPOs, have even more positive unconditional skewness, or a high probability of poor returns along with a low probability of positive returns, greater on the first day. Good names in the market have high prices because they are profitable with low capital. Value stocks are less profitable as the cost of capital is high, leading to lower prices of the stocks. This has been studied in another 2011 paper on the IPO's high probability skewness. In another 2006 paper, the stock prices are shown to be based upon the market prices, with their values decreasing as their profitability and income growth decline. Also, their capital cost was shown to be growing as other values were decreasing, overall showcasing the underperformance of the glamour stocks. Nonetheless, some businesses truly are grand in every way and successful in their returns for longer periods. Expected returns remain thus open for analysis, debates and discussion. When based on thorough studies and facts, these expectations turn into predictors for the realized returns over a longer period of time into investments. Good companies are not always good investments based on thorough studies, research, data and facts, analyzed on the basis of investment returns, although the scope for exceptions is always there. A lower stock price ensures most often than not a higher return on investment made. Higher expected returns can indicate risks to many investors. Also, in layman's words, those companies that appear grand and glamorous are not always the most loved by professional stock investors as they bear the risk of lower returns. All this consideration will be in vain if you don't compare your findings to a relative base. For some companies, a comparison to the overall market is fine, but most should be compared to their own industries and sectors. If you like this video, then show it to us by giving it a thumbs up. Share your views in the comments below, and we'll see you in the next video.